There are 3 mistakes almost all money launderers make that lead to them getting caught, and today I'm going to tell you what they are. In bank terminology, these are called red flags, and the bank system should pick this type of activity up. Again, this is for educational purposes only and should not be considered legal advice. So the first one is structuring. You probably haven't heard of the word structuring before, but you may have heard of $10,000 being the magic number. If you deposit over $10,000 in cash, then the IRS gets notified. Now, to give you some history, the structuring law comes from the Bank Secrecy Act of 1970. This law required banks to report any cash transaction of more than $10,000. Initially, it wasn't illegal to structure deposits to avoid the reporting requirement. But then in 1986, with the creation of the Money Laundering Control Act, structuring became illegal. Any money launderer worth anything will know about this law and will try to break up their transfers or structure them so they are not at the $10,000 limit. The crazy thing is, the structuring law does not apply to wire transfers, but that doesn't mean that banks won't treat them that way. Most banks will review wire transfers for structuring because if someone's trying to structure, there's something illegal going on, typically. Now, when criminals do engage in structuring like activities, they fall in 2 categories. One is the launderers who are pretty dumb and decide to transfer $9,000 and then $2,000 right after. For some reason, they think this isn't suspicious. Now, while there isn't one transfer in total that exceeds $10,000, all the bank has to do is add the 2 wire transfers up and there you go. Then the person at the bank, who is usually an investigator, asks themselves, is there any legit business reason for the person to have broken up $11,000 into 2 transfers? Especially since that requires them to pay 2 wire transfer fees, which can be $50 each or more. So why pay $100 when you can just pay $50? The investigator is going to come to the same conclusion. Clearly, this was done to avoid the $10,000 reporting requirement, so the person is purposely trying to evade the reporting requirement. Now, the second category of money launderer is someone who structures but knows they can't make the transfers too close to one another. So they will make a transfer of $9,000 and then maybe 5 or 7 days later, another transfer of $9,000. In total, the launderer transferred $18,000. But they think since it was done with a few days in between, they're safe. Now, this can actually work, but only like this. The criminal's account is at $12,000. They then transfer $9,000 out on day 1. On day 4, they get an incoming transfer from a legitimate source for $8,000. The account now has $11,000. On day 5, they make another transfer of $9,000. In this scenario, they would not be considered to have structured because they didn't have enough money in their account on day 1 to transfer $18,000. So that middle deposit of $8,000 removes the possibility of structuring. However, criminals rarely take this approach. They want the money out of the account quickly and will structure the deposits just below the $10,000 threshold. Some even go as far as transferring $9,999. I kid you not. I've seen these transfers. I guess they think everyone who works at the bank is dumb and will just not pay attention. They're wrong. Now, the second way that money launderers are caught is the money in and the money out. Now, this method may have different terminology depending on the bank, but in essence, it's the quick movement of money shortly after receiving the funds. The way it works is an account owned by either a person or a company receives typically large incoming transfers. Now, typically the transfers are higher than $10,000, and the money stays in the account anywhere from a few days to even a few minutes. The time it stays in the account typically depends on how long the criminal actually wants the account to stay open. If they have no intention of using it to launder money on a continual basis, then you will see the transfers go in and fly out minutes later. Now, for those that have some intelligence, the money will stay in the account for a few days before being transferred out. The really good criminals will use an account that does legitimate business wire transfers on a regular basis. This allows them to sneak the transfers in among all the other ones and hope no one notices. This works sometimes, but not all. That's mainly because the person at the bank who investigates these transactions is going to look at a couple of factors to determine if they're suspicious. Like 1, does the money come from the same account every time? 2, is the amount of the transfers roughly the same? 3, did the account have enough money to make the transfer even before they receive the incoming transfer? 4, what is the relationship between the sender of the transfer, the account, and the eventual recipient? If through investigation they can see that the money comes from the same account every time, the sender doesn't have a logical relationship with the account had enough money to transfer without waiting for the incoming transaction, and there isn't a logical relationship between the account and the recipient, And lastly, the activity doesn't make any sense. This is the end question every investigator has to ask themselves. Given all the data and the quick movement of money, is there a pattern, and does the activity make good business sense? If it doesn't, the account is going to get a SAR filed. Now, the last red flag is what we call activity burst. This is somewhat like the money in and money out, but not quite. This is when there's an account that's been open for a while and has moderate usage for wire transfers. Maybe they do 1 to 2 transfers per month. Then out of nowhere, they have 10 wire transfers in a 30-day time period. This throws up huge red flags in the bank system, and the account is going to be investigated. Smart launderers like to do what I call account seasoning. This means opening an account for either a business or an individual. They'll conduct what seems like normal transactions and typically do it for at least 90 days to maybe 6 months. Now they know that opening an account and immediately moving large amounts of money quickly will likely lead to the account being shut down. So by using it normally for a few months, it'll reduce the chances of the account being shut down. What they don't realize though is that just because you season the account doesn't mean this account is going to be overlooked. When you have such drastic departures from the account norm, it's going to require a review. What launderers don't seem to think about is that when you open an account and they ask you all those annoying questions, it's for a reason. Those questions let the bank know what type of activity to expect from you, and also it allows the bank to give you a risk rating. That risk rating is critical because it helps the bank to determine their entire customer risk level. For example, a typical customer that works a 9 to 5, gets their paychecks deposited in the account, pays their mortgage, and has a savings is a low risk account. The bank knows what to expect, and they want as many as these types of customers as possible because they can take those deposits and lend them out. But if you have someone who comes in and plans to conduct 20 wires a month and owns their own company or got their money from inheritance and the wires are going to international destinations, well, this is a significantly higher risk. Not to say the bank won't take them on as clients, but they will watch them a bit more carefully. Activity bursts typically happen to accounts that were considered low risk and then in a short time frame start acting like high risk accounts. Since this almost never happens for a good reason, the bank is going to be looking at the transactions pretty intently and will likely end in a suspicious activity report being filed. All right, guys, so that's the 3 most common ways banks catch money launderers: structuring, money in and out, and activity bursts. Now, they're not as complicated as people think, and though some money launderers can be smart, many make the same dumb mistakes. Comment down below and let me know if you have any questions about any other money laundering tactics. Make sure you smash the like button for the YouTube algorithm and subscribe with the bell notifications. I will be in the comment section to answer your questions. Peace.